What up, everyone? This is Chris. This is Wheelhouse Trading, and welcome to the Wheelhouse. Okay, shitstorm arrived. Ouch. Yeah, painful. This is why we use stop losses. This is why we use a system. This is why we use indicators. This is why we trend trade. This is why we watch all this stuff above 200, below 200. Is the cloud closing? We watch our EMAs. We watch our indicators. And we pay attention to that. And then there are ways out if you get into trouble. However, you will need money. The goal is to mitigate loss instead of letting it bleed. You don't want to keep bleeding and bleeding and bleeding. You want to get with those small loss. First, we'll just back up a few videos. First, when you see the trouble, for instance, like this is closing, and you can also see right here your MACD is closing, and your stochastics coming down, and all these different things I teach you. When that's closing, you got to get out of your Dow stocks. You just got to get out of them because it's getting bad, okay? And it's about to, it's telling you got to get out of them, okay? And then you sell the ones in the profit. You move that money to the side so that you're reducing margin, you're reducing risk, and you're realizing some gains. Then, when it drops, you wait for a pivot, and you go after the smallest percentage loss first. Then you have to wait for that bullish pivot to go up. And then you put a bunch of money in on that same position. If it's down, 6%, double it's 3%, triple it, it's 1.5%, quadruple it, it's 1.75%. You get the drift. But you got to do that heavy into your smallest loss while the indexes are coming up and the whole market's coming up. That way you have more shares, less percentage loss. You'll have the same dollar loss. You'll have more shares, and it'll push you up, which is easier to get out at even, or even sometimes a little bit of profit, and you're de-risking. Now you have more money, and then you wait either for the next one that's the lowest one, wait for that pivot, or maybe you can handle that the same day, and you work down the line and you de-risk. You don't want to hold in this market. This thing could get nasty, guys. I don't know. Maybe we hit the lows here and we double bottom. Or maybe we come down to this old support over here from March 25th, 2021 on the Dow, and that's 32,032. Or maybe we do what a lot of these stocks have been doing, and we go back to the peak before COVID, and we come down another 19%. I mean, it happened in the financial crisis. It happened in the dot-com bubble. It happened, I believe, in 72, definitely happened in 29. So, I mean, it can happen. And right now, this market is driven by sentiment, and the sentiment is bad. And let me tell you, from what I understand, the reason, well, there's a lot of reasons that this happened. There's several reasons. We'll talk about it. But what initiated the big sell-off was early in the morning, there was a $15 billion at the market, like pushing out a lot of stocks. Liquidating, okay, and that just created havoc across the board. All the algos picked up on it. Institutions were like, whoa, I don't want to be last out the door, and it just got dirty. It's hard to hold cash, but it seems like it's better to hold cash at an 8% inflation rate or whatever it is versus dropping, these kind of percentages. Let's see how much we dropped. So we dropped 3.12% on the Dow. At one point, I looked up at Bloomberg, and it was almost at 1,300 points. That is insane, okay? In 1980, I think it was 1987, the biggest drop in one day was 22% in one day on the Dow, okay? Can you imagine what a 22% drop on the Dow would be like? That was called Black Monday, I believe is what they called it. Can you imagine what a 22% drop would be like? And you just experienced a 3% drop? Savage, right? Straight savage. All right, so look, I'm not going to BS you. We're breaking all the key levels of support. A couple of videos back, before Jerome Powell spoke, I said, look, moment of truth. We're at the precipice. Either the market reacts in a positive way and we get a bullish pivot, okay, which was right here, boom, and we got a bullish pivot, okay. But then a little bit of digestiveness over the evening and some selling, which led to more selling. Remember, momentum breeds momentum, and lo and behold, all 11 sectors down, man down. Everybody's dying on the battlefield. Can't get any foot soldiers in there. Can't get any helicopters in there. It's bad, man. It's bad. This is why you want to have that cash on the side. You want to have the cash in the bank for these types of days. Not to buy the dip, because you're not buying the dip. You need to buy the bottom. I don't think we're at the bottom. Now, I thought maybe we get a bullish pivot and we get a rally. But if not, it was looking really grim. Well, it's obviously looking grim. The only time that you get these crazy high volatile whipsaws are pretty much in the bear markets. When it's a nice clean bull run, I mean, your volatility is low and you're just getting more up and down. This kind of stuff right here is erratic and it's dangerous to be in it. If you have positions open, then what you want to do is get rid of ego, get rid of emotion, get rid of conviction, get rid of all of it. What you want in your head, you need to go woo-saw. You need to take a second, and you basically need to come up with a plan. Remember, if you don't have a plan, your plan is to fail. Okay, this is what you can do. As long as you have already, if the stops were hitting, you're already moved to cash. That's great. That's the way. And you just take it on the chin, and you just hold tight through this whole thing, and then you get, you have your liquidity so that you can buy the bottoms and you can do the convictions and do all the things that you want to do. But right now we're in damage control. We're in defense mode, right? So what you want to do is, as an example, let's just go over and grab Bitcoin real quick, so it's relatable, as I'm sure a lot of people have Bitcoin. Bitcoin got decimated, but what did I say? Bitcoin is attached to the NASDAQ. Period. Like it is. And this is bad. Like we break the neckline. We're coming down to this low. That's 32,000. I think 35 area is we got down to 35,681. Holy. Yeah, Bitcoin took a bath, so cryptos got hammered. So what you want to do, you're in a downtrend, okay? Everything is saying this is going to keep coming down on the macros in the stock market and Bitcoin, which is like an index for the alts, right? But everything is showing that it's still going to come down. So what you want to do is you don't want to be focusing on that crypto that's down like 30, 40, or 50%. You want to focus on that crypto that's down like 10%. Even if it's Bitcoin, you can buy it again at a lower price. What I'm trying to talk about is mitigating some risk. So let's say, and it doesn't matter if it's Microsoft or if it's AMC, it doesn't matter. It doesn't matter what the ticker is, crypto stock. What matters is the process. Okay. In your mind, it's coming down, but you don't want to take a big loss, nor should you. You're in this situation because maybe you didn't have a strategy, or you were just a buy and hold, or you didn't go through a market crash before, you didn't have stops, whatever the case is. That doesn't matter. It's irrelevant. What we need to focus on is a solution here for you. So what you do is you take that one crypto or stock that's down the least, okay, and you have to wait. You have to wait for momentum, okay? And what I like to do is I like to do it on the hourly. Like right here, this is not good momentum. I mean, the HMA is coming down. That cloud is nasty. You're getting some consolidation. Yeah, it's showing a little bit of strength. If I go look on the minutes, it's probably getting a little push. But essentially, looks to me like it's going sideways. I mean, that's sideways action, okay? That's indecision when it's sideways or consolidated. So what you want to do, instead of just like averaging down and hoping for the best in a downtrend, that's called buying the dip. The dip might keep dipping, okay? So what you want to do is you want to wait for bullish momentum. You want all the conditions you want this thing to come down, reverse, go blue. You want these things to turn around. You want all this, you want to wait. You want to let it drop. That 10% might go 12, 13. But when that happens, you want to be ready to deploy cash into momentum. So let's say you got your Bitcoin, you're down 12%, you double your position, you're at 6%, you triple it, you're at 3%, quadruple it, you're at 1.5%, you 5x it, and you're at that 0.75. Now you're still at the same loss, but you have a less percentage on your money, but you also have more risk because you put more capital in. But your risk, don't look at it like that. if you're doing it correctly. The correct way is it has to be going up in momentum. So that small percentage and that same dollar amount, it'll get cleaned up really fast if it's a momentum day. You have to wait for that day. You can't say, oh, I'm going to do it today, or you don't get to pick. You have to listen to the market. There are these certain moments where things rally, like 2 days ago, and they rallied really, really big. That was the type of day I'm talking about. They show up when they do. That's when you want to get your money in so you can get out. And don't get tricked into thinking, oh, it's going up. It'll probably go up tomorrow. No. No. You got burned touching the hot pot, didn't you? Yeah, you don't want to do that. So you got to go into it with the mindset that you are getting in to get out, and you're doing it fast into momentum. It should only take no more than 30 minutes. Sometimes it's 1 or 2 minutes. I like to make sure I'm bullish on this is how I do it. I let it drop. I wait for it to get bullish on the hourly, because nothing is going to be really bullish on the daily right now. So you're going to have to work from the hourly lower. It needs to at least get strength to the hourly. Then what I do, let's imagine it looks like this. It's got the blue, it's got the cloud, it's above the 200. That's bullish on the hourly, just so you know. Then I come over to the minutes, and what I do is I let it drop, because it's an ebb and flow the way these things work. So what I do is I let this thing drop, even though it's bullish on the hourly, and then I wait for the reversal, and then I buy right here, and boom, I deploy it, and I just hope for the best. And almost every time, because the way I have my indicators, it'll push up, especially if it's bullish to the hourly, because it's already showing trend and momentum. So you average down here, and now you're at a tiny percent loss, and you let it run up. Boom, 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 and then boom, you see that arrow or whatever condition you use, and you get out. And even get out, even if it's like 2% loss. You just mitigated so much damage, and you have that money safe on the side. You got to work down the list, okay? That's how you got to do it. Guys, we broke the supports. We're in a bear. It's crashing. Like, sorry to say, I know that we, might get some movement between May 11th when the CPI report comes out, but let's just not count on it. Let's just be defensive. Let's just stick to our guns. Let's be tactical. Let's be strategic. Let's we got to get our soldiers off the battlefield. That's what we got to do. We got to protect our dough. All right. No messing around. You can't, no loose talk, no second thoughts, and definitely no maybes. Okay? Because if you don't have your money, you can't make money, right? So it's very important to, have a plan, have a strategy. And if you're learning it now in a bear market, it's not the right time, but I'm here to try to help you just in case. That's why I got on YouTube originally, was to help people. And I can only assume that people are taking some damage. I took some damage, but I'm not fully exposed because I am doing a system. And I also am trading, day trading, and I'm also shorting, and I'm also hedging, and I'm also doing inverses. So when the indexes go down, the NASDAQ, the SPY, the Dow, and the Russell, when they go down, I make money, okay? Because I have SQQQ, so that means short the Qs, NASDAQ. So when the NASDAQ index goes down, I'm making money. That's a hedge for me against my longs. SDOW, when the Dow goes down, I'm making money. SPXU, when the SPY goes down, I'm making money. TZA, when the Russell goes down, I'm making money. And I have a couple other ones. One's called Webs. And I sold the one called Hibbs. But yeah, I have a few, and those are hedges. Those are the only ones that really are making money. Then what I'm doing is I am trading. I am trying to buy long, but now I don't think I'm going to. But there's ones that look like they're bottoming, but they could be bottoming and then fall through. Let me show you something. Let's go back to 2008 real quick, and I just want to show you something here. Okay, so this is the NASDAQ currently. Okay, let's just get this in our mind here real quick, okay? Let me just show you something. Let's put those ribbons on so it's a little brighter for the YouTube, for the old tube. And, okay, this looks nasty. This is nasty. It's gross. It's dirty. It's, I told you guys 8 months the other day, but it's actually 6 months it's been going down, because I told you from November, but that's not actually the high. So it's been coming down for 6 months, which is a long time. And it's really hard to go long, and I want you guys that are watching this to understand this. You don't want to fight the red tide, and you don't want to fight the Fed. Okay, this is why I'm so big on the indexes and the macros. The macros tell the story. Red tide sink boats. Holes in your boats, you're going down. You got to plug it or you're going to be at the bottom of the ocean. Green tides lift the boats. The problem is that we got a lot of red tide going on. You can tell by the purple ribbon, the red HMA, the downtrend. I mean, a new primary trend, which is the direction. I mean, we have problems, right? So going long in this is hard. Trading it off the pivot into momentum, you can make money long and then short. And that's why I have longs that I trade. I try to get really, really good technicals on the longs, and I'll scoop up little bits of money. But when it turns, I also have the hedges on there. Okay, so what happens is whatever direction the market goes, I have more of that going. So if the direction's going up, I have more longs, more shares and more money put into longs. If it's going down, well, then I have more shorts or hedges put in there. So my equity curve, I'm making money even if it's going down, but maybe not rampant volatile money. I'm easing in, and still the money is good if you do it right. So you want to weight it in the direction. Then if it changes directions, you can trim your hedges or pull them off completely and let those longs come up. You could actually stack into the bullish momentum to reduce risk. And then when it changes directions, you throw those hedges back on and you just ladder step it up. You ladder step it up until you get the risk out. I know it sounds complicated, but guess what? I got a Discord. The description link is in the description below, and I can help you through this. I can help you navigate through this. I promise you. I'm helping people all the time. In fact, I just did a Wheelhouse Wednesday night, and I did a group training open to everybody, and I was teaching everybody about this method called the 70-30 method, where you de-risk a certain way in market environments like this, and you get at least 70% of your cash out. Being all in cash right now would be completely fine. It would actually not be a bad idea. I just think that you should go in the direction. You should short or inverse or hedge your longs. But what you don't want to do is just bleed out. You don't want to bleed out, guys, okay? Like, don't just let it go and be like, it's going to come back, because honestly, what if this thing goes down for another year or year and a half? And what if, the recession happens and you lose your job, or gas just goes up to, extreme, or who knows what's going to happen in recessions, right? And by the way, you're already in a recession. We're already having slowing growth. The retail numbers came out. Okay, guys, these are important. Okay, these are data points, okay? You got to listen to what the Fed says. You have to understand and feel out what the market consensus is, okay? How the Fed reacts, what they say, and then focus in on the data points. Okay, the data points are going to be the CPI number. It's going to be, is there a reduction in the pace of inflation, like month over month? Is it going up as much, or is it starting to taper and slow? Have we topped? Are we peaking? We'll know if we're at the same. Well, the real estate market peaked and then it went down and then it shuffled up. So I guess we'll have to watch that for a few months. That's going to be important, the CPI data, and then the rate of inflation decreasing against other benchmarks, like month over month kind of benchmarks. Okay, then you have to look at the jobs. Okay, the jobs data is going to be critical. Okay, because if it is so hot, then they have to slow it down. And like I was telling you guys, the Fed had a plan all along. And the plan was to raise the rates, try to combat inflation, and they would crash the market temporarily, and they would create a recession to slow everything down, and then they would lower the rates years later to pull us out of a recession. And the whole reason they do that is because the other option is to not raise the rates, let inflation run hot, and risk the world reserve currency. Notice how the dollar has been going up like to the moon. That's another thing. Equities probably won't be going up until the dollar starts to come down. The dollar is high right now, guys. Also, oil is high right now. Yeah. Okay. Back. I don't want to get too scrambled. Another thing you got to watch. So CPI, the rate of inflation, increase or decrease against time. The jobs data is critical, and then the spending, the velocity. M times V equals I. Money times velocity of spending equals inflation, right? So if the velocity of spending slows, that's going to be a big indicator for the earnings reports and more slowing growth, essentially. And guess what? It looks like there's less retail spending. We got problems. So this is why I'm in here like a captain right now, like, you know, screw the push-ups and the jogging, like get strapped up. I need all your ammo, grenades, canteen. We're going out, we're going hard, okay? We got to get those soldiers out off the battlefield right now, okay? It's serious. Don't worry about, oh, I like Apple at this price. No. You're going to get Apple at a lower price, homie. Check it. You will. You're going to get all of them at a lower price. I'm telling you, this isn't good. Now, take a visual look. Pandemic, boom, bull run, propped up, stimulus, crash, okay? Let's just go back to 2008 in time. Let's just take a little peek here. Oh, I just got all of them marked off for us already. 15, 16, 18, 2011. Oh, and then all of a sudden, one day, there's this whole thing called credit default swaps, mixed bag of all these adjustable mortgages, and boom, financial collapse. Okay, now, sorry. Come on back. Okay, so here's the financial. There's the peak. There's the COVID, let's just say. There's the bull run, okay? And there's the crash. And then, boo, little bull trap, which I made a video on, okay? And then something happens, and you think that this is bad, and then something happens, and it goes like this. Was yesterday the first day of this? Well, the Bank of England came out and said, hey, we're going to have double-digit inflation. We got stagnation, stagflation, and we're going to have a recession. We're just going to tell you. Markets didn't like that. Then you get a $15 billion market sell-off early in the morning. That triggers stops. That triggers other selling, like margin calls. Who knows? Like, momentum breeds momentum, guys. But first one out the door is probably the smart one, right? So you got that going. And then you have what I was joking around about in the last video. Like, nobody believes Jerome Powell that we're not going to have a recession and that we're going to have a soft landing. Like, you got to be kidding me right now. I was kind of like, okay, well, if he wants to lie to the markets and the markets are going to rally like this, like, whatever, that's cool. I mean, he lied about transitory and they bought it, right? And I didn't buy it. Transitory has never been attached to inflation in the history of the world. So that was like a new thing, by the way, that he like made up, and like somehow like everybody bought that. It was trippy. But yeah, so look, you got midterms coming. They just missed on GDP. It's a big smoke screen, and the market is saying, we don't believe you, Jerome Powell. We don't believe there's a soft landing, because any which way we work the numbers out, is it possible? Yeah. Is it likely? No. Is the probability leaning towards hard landing? Yeah, you can already feel it in your portfolio, dude. You're already in a bear market. You're already in a crash. You're already in a recession. Wake up. You ever seen that little graph where it's like the psychology of the market phases, like euphoria at the top, and then it's say something like doubt or disbelief, or I don't believe it. My stuff will come back. Well, why? Why does it have to come back? It might not come back for a long time. You know how these things rotate. You know how the sectors change. I mean, obviously Warren Buffett and myself and some other people saw commodities coming because of supply and demand, but I mean, a lot of people didn't really know that. And, we were on that many months, like before it even started. And, then people jump in that and it kind of falls back. So there's a lot of stuff you can't predict, and that's why you have to have a system and a strategy. You have to play offense in the bull run, and that's an investable market where you can actually buy the conviction, and you can do dollar cost averaging in an uptrend in these big dips that happen. You can do that stuff, but in a downtrend, we have to be defensive, okay? If we're going to win the game, which means get our soldiers our money back to safety and, survive to fight another day, then we have to be rational. We can't be in disbelief about what's going on. It's already happening, guys, okay? I said we were at the precipice. If we did not hold the line, okay, then, if the market didn't like what Jerome Powell was going to say, we're probably going to go down further. And it could look so like this is, okay, here's where we've been. Here's the day Jerome Powell spoke, okay? Boop, little pop, and then boom. You don't want that. You don't want these 55%, 56% drop, guys. We're only at, I think it's like, what are we on the NASDAQ? I think the NASDAQ's like 22% or something. Let's just check real quick. $15 years of crashes right there. Okay, so the NASDAQ, we have to move this thing because it's come down. NASDAQ is right there, 22.88. I was close. I said 22.23, right? So yeah, really close. That's a bear market, okay? And you're breaking this major level where it double bottom, actually bottom, and you're below it now. Jesus. You're below it, okay? So next stop is right here. I mean, there could be other stops. I don't want to just say it's like it has to be that way. I mean, it could be right here too, okay? Where it's at, actually. It looks like there might be something here. So there's some stops, but I mean, these ladder steps down are following the primary trend down, and you're in a downtrend, so why are you trying to go long? That's what I had to tell myself. Bam, why are you trying to go long? You're trying to get a good deal. Well, that's because I thought we were going to get a bullish pivot, but no. I have to check myself real quick. I put my stops on. I got stopped out on a bunch of stuff. I took losses. Now, I didn't buy full positions, thankfully, because I've been around the block a few times. And, I didn't go heavy, and I did set my stops, and I didn't even set them at 8%. I set them even tighter. And they moved me cash, and it took an L. But I got my hedges, and my hedges were good. So, you got to know how to play the game, and you got to know the rules. And right now, I normally would say that, and how are you going to win if you don't know the rules? But right now, the rules are very obscure, even for me. What I'm getting from this market right now is it's not fundamentally driven. It is basically driven on uncertainty, fear, and sentiment. And all of those are down right now, okay? Until we get some sort of certainty with like the war or the COVID lockdowns, which will affect the supply chains. These are data points, okay, that will affect sentiment. We could be in it for a long road here, guys. I'm sorry, I don't mean to be bearish. I just trying to keep it real. I just, a big what if scenario. And I've been saying it since here, and I've been walking you through it daily. And then in the Discord as well, like all this stuff before it kind of happens. And, when we get to these major levels, it's either boom, pivot, rally, or the other way. And we got a rally, so we all got a little tricked. Everybody got a little tricked, and then it sold off. You got to make an executive decision quickly when that happens, okay? Come in the Discord. Let me help you navigate out of this. Let's reduce positions. Let's get ready for a bullish day. When it happens, we can get the money in right into momentum and pull it out and de-risk. And you want to do that. That's how you can get out of this thing. Also, everybody watching right now should have SQQQ, SDAO, and SPXU in your portfolio as a hedge. You'll make money as the indexes go down. If you can't get them all, get at least the SQQQ one, which is the NASDAQ, the one we're looking at. And I'm going to cut it there. I'm just going to keep it short. This is just like a warning, okay? Bitcoin is tied to the NASDAQ. If the NASDAQ isn't happy, Bitcoin won't be happy, and the alts are under Bitcoin because Bitcoin acts as an index, okay? So we're just in trouble at this point. We're in trouble, and we need to have a plan. We need to have a strategy, and the goal is to protect your money. The goal is not to, buy the bottom right now, because We don't know where that is now. Okay, there might be some bullish days. Don't get tricked. Use those bullish days with a plan and a strategy to de-risk. That's what you got to be thinking. Trust me when I tell you this. Tomorrow, there's always another day. There's always a tomorrow, and there's always another trade. There's another trade in 5 minutes. There's another trade in 10 minutes. There's another trade an hour up the road. There's another trade tomorrow morning. I promise you. Been doing it a long time. You can take days off. You do not need to go long against a downtrend. And when you break key levels of support in this significant of a scenario where you're dealing with a food crisis, supply chains, COVID lockdowns, shipping problems, and I mean the marine shipping and vehicle trucking, and then of course inflation, hawkish Fed, recession worries, we got to watch the retail spending. We got to watch these guys with their pricing power too. I mean, there's a lot of data points that are, the more they come out, it's drawing the conclusion of a slowdown in the economy. And so that's why I say we got to watch this jobs data. Okay, we've got to pay attention to that, and we have to pay attention to the rate of inflation. Is it going up faster? Like, was it? Let's just, as simple numbers. Let's just say in January it was 7%, and in February it was 8%. Well, the rate of inflation was it went up a whole percent. Okay, for simple layman's terms. Okay, but then let's just say this is March, and in March it went from 8% to 8.75. So it didn't go up a full percent; it went up 0.75%. That means that the rate of inflation is decreasing, and I think the markets would like that. Okay, but there's multiple data points. Okay, the war is one, supply chains is another. Got to keep an eye on oil. The retail spending is slowing. The COVID lockdown is tough on people because of the supply chains, and that can affect earnings. And then you got a Fed that I think is full of it right now, or maybe they're not. Maybe they just are doing exactly what I said. They're just building a framework. They're protecting the world reserve currency. They're going to crash the market. Screw your money. Screw your portfolio. We need to take the money out that we put in anyways. We don't want you to be rich anyways. And by the way, when they take the liquidity out of the market, what that basically is them crashing the market. So you panic sell, or you it breaks you so that you have less money to spend, and all these. It's a process of slowing. It's a way that they'll do it. So I mean, they're not going to pull liquidity out and bring it to their backyard and put it in the fire pit and the wheelbarrows and just burn $100 bills. No, this is how they're going to burn liquidity. They put a lot of liquidity in the market with stimulus, and this is how they need to reduce it, is by bringing this down. And they need to raise those rates, try to get inflation down, which they're not going to be able to do easily. It's not going to be soft. And then they need to, they will at that point be protecting the world reserve currency instead of debasing it. That's another reason why our crypto is going to be going down too. So every time that they say rate hike, it narrows the inflation window, and everything is forward looking, right? So if Bitcoin is an inflation hedge and it's forward looking, and it says, hey, we're going to be lowering inflation, well, that probably will lower the price as well. And the indicators and charts are telling me that as well. Again, sorry to be grim. I totally love you. I appreciate you watching to the end. Welcome to the wheelhouse.